Welcome back, and we're joining you live from the Suzlon studio here at ET Now, and I'm joined by Nirav Sheth. He's here to give us his perspective of how do you see markets at this point. And Nirav, it's again the global geopolitical environment continues to be volatile, right? And as a result of that, you're seeing again crude behave in a choppy fashion, but I believe that businesses have started to evolve and have started to get accustomed to this as the new normal. You believe that the effects now will be far lower, and crude at 95 or 93 and change should not really bother the street per se.
Well, I will not say that it should not bother us.
Okay.
Uh, that is one of the trade. So, the big companies that will be negatively impacted, you have to take price increases. And obviously, there consequently, there could be some dip in volume and stuff like that. So, yeah, it is just companies adapt in terms of curtailing their cost, in terms of their.
Nirav, Nirav, I have you on a very patchy line, Nirav. So what I'm going to do is take a bit of a pause on this conversation. I'm going to get this repatched. And while we are at it, curious to know with regard to Kunal, your view, how should one look at some of the big movers today, right? A Welspun Corp up 14%. 10% higher on Jindal Saw. How are you looking at a couple of these names which have done extremely well in trade?
So I would actually believe that this could actually be a good time to try and book profits in the likes of Welspun Corp. The stock has moved up massively over the last, I think, 6 months or so, almost like a 3x jump from 710, 715 levels to 2300 approximately where the stock is trading right now. So after that kind of a sharp rise, as well as today's gap up and that exceptionally strong volume, I think this could actually be a good time to try and book profits over here. Jindal Saw, on the other hand, this could probably be potentially a breakout move. Today's candlestick pattern so far is what we typically call it as a bullish Maru Bozu candlestick pattern. The volumes today are at a multi-day high. The stock has come back towards a multi-week, multi-month high at the current level. So it looks attractive, and the stock can see a follow-through up move. Expecting the stock to maybe come back towards the range of 310, 325 over the near term.
You also sounded bullish on power, Kunal, when we spoke earlier a few minutes ago. How do you bet on power, and what do you make of the move on power grid? It's not often that we see this kind of 3% kind of move on a power grid.
Exactly. I think that's one of the major reasons why I would believe that maybe this could be a signal that the markets are now trying to look at the power stocks as interesting bet, because what's actually happened is that power grid has tapped into this territory of 250, 260 thrice in the last 1.5 odd year. So 2025 start, the stock was at 250 levels. 26 start, the stock was again back to that 260 mark. And now we are back again to that 260 levels from where we've seen a bounce back. In the two versions of the bounce back earlier, the stock had moved towards 300, 320 approximately. So from those 250, 60 levels to 320, it's almost like a 20% up move for the stock price. So after this price uptick, there could probably be a case that the stock may come back into this kind of a bounce back mode. Of course, the time frame could be a little bit more extended. It takes at least 6 months to 9 months for the stock to show that kind of a bounce back. But the only caveat is that we need to see a follow through up move for the next couple of days, because if this is not an expiry related move, then I would believe that the stock can sustain this uptrend and head back towards the 300 plus mark.
Okay. What we'll do is take that quick break, come back, we'll hopefully patch Nirav Sheth by then. He'll come in, give us his views with regard to markets. Looking forward to that conversation actually. Stay with us. Welcome back, and we have with us Nirav Sheth of MK Global. Much awaited conversation. Nirav, thank you so much for joining us.
Thank you.
Nirav, you were giving us your perspective. All the uncertainty, you were saying that it does bother you to some extent. Give us your sense.
Yeah, so in a sense that the fact that it impacts my current account deficit and inflation expectations and rupee depreciation. That's a very, very vicious circle, right? all the problems that have happened in India essentially only flow from the current account balance or the trade balance. So we need to be conscious of that. You are not at a level that will seriously worry you, but uh, is there a clear line of sight ahead? Probably no, but we live with that. There are bigger problems. You also have bond deals which are making decadal highs and all. So that's the fun. You have to deal with all these things.
And with regard to the sector churn as well as small, mid versus large, as well as the Nifty call, Nirav, give us a sense. How should one look at those three metrics? One, the Nifty call, small versus large, and the sector churn.
Right. So let me come to that, right? So let me just try and give an hypothesis of what I'm working on. Uh, Today, when I look at the 30-year bond deals, they are trading at about 5.3%. So this is risk-free US dollar return, which means that anyone trying to look at investing in Indian markets, you will pair that up with equity risk premium, which is about 3 or 4%. And there obviously there's rupee depreciation. I don't think anyone will look at India at less than 12 or 13% dollar returns, which means that if my earnings are not compounding at 15 or 16%, it doesn't make sense for bulk of the FIs to look at India as a market. And that should be the construct of the portfolio, the way I look at it. And thus I come to the question that you asked me. I believe that Nifty 500 will outperform Nifty 100. Nifty 100 will outperform Nifty 50 because that is simply the earnings evolution. The broader markets are growing faster. The companies that are in the broader markets are growing faster, maybe because they are smaller, but that is the construct of the market. So I expect what is playing out in the market right now will continue over the foreseeable future. Uh, the problem in Nifty is lack of earnings growth, right? So you got IT, which the best case estimate is mid-single digit earnings growth rate. You've got banks that are compounding at between 12 and 15%. That is the best case scenario. And therefore, it boils down to companies that you like. You're talking about something like, you've got Eternal, for example, where you expect earnings to compound at 30-40% for several years in a row. And yeah, so that is the way I look at it. You have to chase growth.
Got it. Chase growth. Sectors, Nirav, that you're chasing growth in.
Yeah, so within banks, for example, again, you look at the mid-cap banks, again, the threshold being 20% earnings growth rate. You look at NBFCs. We are very bullish on platform companies. And this is my personal belief, I may be completely wrong, but I think there is some sort of disconnect in the market. They tend to look at unit economics, and some of them think that, these are loss-making companies, and therefore, they're bubbly valuations. We have a different point of view. We believe that, they've got phenomenal moats, and I think you will see a lot of these companies making very, very serious return on capital employed as you move forward. It is just that a lot of the expenses, or if you look at old economic companies, lot of what they put in on the ground actually gets capitalized, and it becomes a part of the capital employed. For all these new age companies, they tend to get expensed out, which is why when you start making profits, you will have very, very high ROCs. So, you need to make a bit of judgment over here. And then obviously, you've got these big opportunities in the supply chain of data centers and, eventually power utilities. We like this space.
So, Nirav, just the fact that there is no growth, let me play the theory of an elimination now, would keep you away from private sector banks to a large extent, would even keep you away from large cap IT, would mid-small IT feature at all?
I am very negative on IT, right? So I am firmly of the view. So I can be completely wrong, right? So I believe the sector is getting disrupted. People are talking about the fact that every time you've got a serious deflation in the cost of IT, the volumes will expand. They call it Jevons paradox. Again, to me, we are not very sure. So certainly there will be an expansion of the demand for IT services. You're not very sure where the profit pool of IT will move. There could be new competitors. It could move away from what the Indian IT companies are serving today. So for me, I will, if I was fund manager, I will probably run a zero weight on IT. within IT, certainly the mid-cap ITs are better placed because at least they seem to be growing in mid double digits. The likes of Persistent and Coforge. The expected, I think the guidance again was about close to 15-18%. Relatively better place, but that is when you put a gun to my head. To me, uh, it's very difficult to try and we are. I'm a great believer in AI, right? So I'm not talking about the valuations, but the fact that the technology is profound, and therefore the way we look at it is that people who are on the wrong side of AI, it is easy to figure out who is going to get impacted, and you just stay out of that. Do you really care about what the print media is doing? I distinctly remember 10, 15 years back, and I was a media analyst, and people used to talk about the fact that no, if you've got vernacular languages, nothing will happen to print media. Let the broadcasting come. Nothing works. When a sector gets disrupted, it gets disrupted. X growth valuations are very, very poor.
No, point taken. So you play AI. You play AI through power to some extent, I believe, industrials to another extent. Then there's
Yes.
IT and hardware technology. Maybe that's the third way in which you play AI. But where are valuations and where is risk reward the most favorable at this point, even within these probably pillars? And if there's something I'm missing, please add, Nirav.
So I agree. So I'm not saying, for example, you can always argue that valuations are ahead of the story. Sometimes the stories are ahead of the valuation. To me, when you are running an institutional portfolio, the only way you can cut the risk is by cutting the size of the bet, right? So if I like a particular theme, I think the valuations are not really in favor, then I probably start with an underweight position or a mild underweight. Because let's be very clear, it is not that you can forecast something with a great level of certainty. This is no longer the world where you can take a 10-year view because you have no idea what will happen in 10 years, right? And I can say this very, very confidently. I mean, look at this company called Ather, right? It got listed about a year back, and our understanding is that it was struggling to get the IPO through. They have to deep discount, and the stock is up 4 times from there, right? And for the entire sector now, the volumes in demand are ahead of the supply that is there in the market. So that is the nature of the market for you. And you could not have predicted the fact that the consumer behavior is going to change because you've just had a very, very marginal increase in diesel prices or petrol prices, and the stock has gone bonkers because the demand has gone bonkers.
No, but that makes a lot of sense, and in fact, I would say a lot of the companies would want to at least the new listed companies would want to pull out a leaf from that story, right? But Nirav, talk to us about the new listings. Anything that's looking interesting? The quantum of fresh paper coming at us is humongous, right? And that is the other thing which is keeping a lid on the markets making any substantial move upwards.
Yeah, so and it's completely fine, right? Because you actually want money into the company. That money eventually gets reinvested, higher capex and stuff like that, and that is the beauty of India, right? So we don't have those $1 trillion companies which have globally adaptable business models. Let's accept that, right? But you do have huge amount of opportunities, huge amount of niche opportunities there in India, right? And it's great to see that you've got vibrant markets. But let me also make a point, right? Because we are running a couple of IPOs right now. I think Biharilal got listed at some 70% premium, I think a couple of days back. The investors have become very smart. They have become very demanding, right? So I think that one of the reasons that you're seeing a very successful IPO market right now is because the valuations are very appealing, right? And which is good, which means that it's a win-win situation for both the companies as well as for the investors as large. So I think, yeah. So I'm not too worried about the supply in the market, and it's good for the economy at large.
Nirav, what you're suggesting is stick to new age. Specific stocks will continue to do well. Uh, uh, quality and value haven't really worked as much, right, Nirav? And you're also saying that FI investments coming into India will still take some time. But what do you make of the themes? When does themes like quality, value start to come back, in your opinion? Everything can't be flows, right?
Yeah, so anyway, I'm not a great believer of that you buy stocks trying to predict where the flows are going to go, because this is, you need to differentiate between the cause and the impact. It is actually earnings that drives the flows, and it's not the other way around. The limited point that I was trying to make about the quality, the only point, the way I look at it is that you cannot have, no matter what the quality, finally you are discounting cash flows, right? And if you've got some companies where the free cash flows are growing at about 6 or 7%, and if you are trading at 50, 60 Ps, you cannot make money. Life doesn't work that way. It works for a period of time, and that is how that if you want to call that synonym, that the bark trade started working for a while, and then something that works for a while has got its own momentum, and it works till the time it doesn't work. But at least my understanding is that you had an unusually low bond yields in the world. So from, you go back to 2010 to 2020, your bond yields came down to percent. In some of the cases, you had negative nominal yields, right? That is a time that, it makes huge amount of appeal, because these companies obviously are almost risk-free in terms of their earnings outlook. When you buy Hindustan Lever or buy an ITC, right? But when you got 4 or 5% cash flow yields, it becomes very appealing when my risk-free rates are 50 basis points. That is not the world that you are living in right now. Right now, you've got 30-year bonds that are trading at 5.3%. And I also believe, and that is not because of inflation, right? Because the reals have started going up. To me, it is probably telling you that there will be a huge surge in productivity because of AI. There will be higher real growth rate. That is my understanding. I may be completely wrong. But given the construct of bond deals at that 20-25-year highs, it is not that try and venture and be buying companies which are growing at 6 or 7% and trading at 40, 50p. I think they'll flatten out over the next 5 years. I feel very confident of that.
That's how you think of it. Maybe value will continue to underperform, just given the fact that you've got bond yields which are going to be higher for longer. Nirav, thank you so much.
No, not value. So, sorry.
Right.
No, I'm not talking about value. I'm talking about something that trades at 40, 50p. That can't be value.
Fair point. Okay, yeah, but higher dividend yields may not be justified at this point of time. I think that's the message you're driving home.
Absolutely.
Perfect. Nirav, thank you so much for joining us. Super chat.
Nice talking to you.
Thank you.